Good evening, ladies and gentlemen, and welcome to Stocks and Bonds with Giorgio and Michael. Our goal is to help you navigate the ins and outs of stock and bond investing. My name is Michael McIver. I'm an amateur investor for over 35 years. With me here is my best friend, or good friend, and great friend, George Danino, a professional investor for over 40 years. I distinguish between amateur and professional by saying an amateur doesn't invest other people's money, but that's what Giorgio does. He's a professional. The format we use in this and future videos is to answer three questions. What is happening right now? Where are we in the business and credit cycles? And what are we going to do about it? And let me start off tonight, Giorgio, by making this comment. In the last 6 or 7 trading sessions, stock prices have jumped amazingly. 10 to 12% have gone up, and the 10-year Treasury rate has dropped by almost 500 basis points. To what do you attribute this?
Well, one of the things that you forgot to say that I manage $3 billion of interest rates derivatives and $1 billion of currencies. I'm saying this not to show off, but just to mention that I have a top-down approach. I don't have a bottom-up. So every questions that you and I are going to entertain, I'm always going to answer from the top down. So you're saying interest rates, the market rose sharply since last October, actually, where it bottomed. And there was a good reason for it. It rose until July and took a shellac until a few weeks ago, and then started rising again.
But why did it take a shellac?
And then at the end of the day, basically the market is at the same levels as of 2 years ago. That's what this market is telling us. You should be a fairly decent market timer. And there are some elements.
Did you say one should be a fairly decent market timer?
Yeah, you have to, what I'm saying is, you have to have a big picture kind of thing, kind of view, but at some point you have to recognize that things change, and even in the big picture. So in that sense, you have to be a timer, okay? Because depending on what the business cycle does, you invest in certain stocks rather than others, and you should expect certain trends rather than others. So, for instance, 2022, the economy weakened, and the stock 2021, the market did not do anything until 2022. 22 started rallying. Why? Well, I got to show you something, because I cannot talk about without a graph in front of me. So here we go. Okay, this is what I compute every day, is the business cycle. And in fact, if you wait a second, I also know how to get a laser. Okay, this is the business cycle, this curve that I compute every day using market data. Okay. And what has happened is, so every time the market goes up, the economy strengthens. Every time this curve goes down, the economy weakens. Why is that important for investors? That's why I talk about timing. Because when the economy strengthens, you should be in cyclical stocks. You should expect commodities to rise. You should expect probably inflation to rise a little bit. You should expect interest rates to rise. When this curve goes down is when the economy slows down, and therefore you should expect defensive stocks, and in fact even bonds, to strengthen. So in that sense, I mentioned timing. So what happened since 2020, the government printed a ton and then some of money, and of course the economy strengthened and the cyclical stocks went up until 2021. This, by the way, is when the market peaked. So since then, we went down, we went up, big ranges, all sorts of things, but the market is going nowhere. So during this period, the defensive stocks, the economy slowed down, defensing was better. At this point, something strange happened. there was a surge in liquidity. Is the only thing that justifies what you, to answer your question, why the market went up so sharply from the fall of last year.
Oh, now, do we know that for a fact? How do you measure liquidity?
I'm not going to tell you because it's a very, I work quite a bit to find out why the market strengthened and why it looks like the business cycle moved higher. And I couldn't find anything that could tell me that. And believe me, for the last 40 years, I go through all the possible indicators that I can find. But there was one little measure of liquidity in the bowels of the financial systems that was telling me that liquidity was going up. And sure enough, since last fall, this measure is going up. And by the way, it's still going up. Even if this curve declined here, still liquidity is going up. So is this inflow of liquidity that is taking the market up?
Yeah, I don't see the inflow of liquidity. I see just the exact opposite. I think liquidity is going down. Banks aren't willing to lend.
Yeah, but there are
the Fed is stopping or is letting $60 billion of treasuries fall off every month. Both of those mean less liquidity.
Yeah, this is the liquidity that you see
and
outside the banking system.
Right? Non-financial?
This is the liquidity that you see outside the banking system, how much the banking system is willing to lend. And since they have not been lending a lot, in fact, you're absolutely right. If you look at the growth of the M2 is actually contracting, which is going to cause all sorts of problems in the next 6 to 12 months. But that's let me call it external liquidity.
The private lending. You're talking about the private lending going on with hedge funds and private equity?
When I told you about this liquidity, is a liquidity that is in the bowel of the financial system, that is between the banking system, the treasury, and the Fed. Somehow there is more money sloshing around that people are aware of. And it's this money that is used to buy stocks. So it is a very specific measure that I'm not going to tell you because I worked too hard to find it.
Have you looked at the statistics?
I'm not gonna, but it's working out. The only thing I can tell you is that it's still going up, actually quite strongly. So, which makes me think that the odds, although the market is overbought, whatever you want to say, is still there is some juice behind the stock market.
Have you looked at the margin, the amount of stock bought on margin over the last couple of years? Is there more buying on the margin today than in prior times? Could the buying on margin be pushing the market higher?
The margins are a fairly coincident indicator of the stock prices, so it doesn't have much value, at least the way I see it. But there is another indicator that tells you that there is a lot of liquidity still in the system. The fact that if you look at spreads between corporate bonds and treasuries, they are still very well behaved. Now, you have a major bear market, a major crisis or credit issue when the corporate bonds get deteriorate relative to the treasury market. Instead, right now, the spread between the two is low, is steady as you go. So that tells you that the credit market, it's not worried about what's going on, and which is why the stock market is going up. Now, for how long, I don't know, but that's the current trend. And by the way, this is not a recommendation to buy or sell anything. It's just a macro view of what the indicators are saying. Now, I can make a long list of why you should be bearish, but that doesn't make any sense. The market follows liquidity. It doesn't follow the economics of things. because we should have had a major decline in the stock market, which it did not have. Now, there is another thing that has also very bearish, which I believe is the fact that the economy is growing, around 1.5% max, and that's therefore stocks will have eventually to recognize that, which is the reason.
But last quarter the GDP grew at 4.9%.
Oh, absolutely. But if you look at really what the market is believing about growth and earnings, the market has not done anything for 2 years. So the market peaks in 2021. So the market is already telling you, you can do anything you want, but the economy is going nowhere, which is what the data show. So that's why I say all this upswing in the markets, ups and down, is mostly caused by liquidity, not by fundamentals. I know it's hard to believe, but that's the way
Yeah,
it is.
it's extremely hard to believe. I'm more thinking that it's the fear of missing out by neophyte investors, or investors who haven't been investing over the last 20 or 30 years.
Yeah, but if there is no money around, you can believe anything you want. But if there is no money, if there is no money, you can, fear of missing out doesn't mean anything.
Yeah, but I can buy on margin.
I know, but again, I go back to the fact that the markets has not done anything for 2 years.
Yeah, but the other thing I've seen, Giorgio, in over these last couple of weeks of high increases in stock prices is the lack of volume. The volume, daily volume has been trending downward now for months. And I didn't notice any. I would have expected a big jump in volume in the last couple of weeks on all these stock purchases, but I haven't seen the jump in volume.
Right, which is that's what I'm saying. The market is going up because there is liquidity, not because there is a fundamental economic reason for the market to go up.
Yeah, but if liquidity should support stock buying, and they're not all rushing out to buy stocks. It seems like it's a narrow group of investors who are buying stocks. I'm just looking at the S&P 500, the average volume. I think it's I don't know what average. I don't know what the average volume is over. I think it's over a 3-month period. For example, on Friday, the average volume was 2.3 billion shares. Friday. The average volume over whatever period they choose, I think it's either 3 months, 6 months, or 9 months. The average volume is 3.7 million. Friday it was 2.2. It's been around 2.2. It hasn't gone much above that. Yet the average volume over a longer period of time is 3.7 billion. This is what I'm experiencing. The volumes are way down in the S&P 500.
Volume is only the way I look at volume, trading volume, is important only in two specific cases. If you see after a strong rally, you see excessive volume, that's a peak. If after a sharp decline, you see excessive volume, that's a bottom. So what you're telling me, the really volume, that's not telling you anything, because the trend is what it is. There is no turning point, because volume is flat. Volume is important only at turning points. When there is a trend, anything can happen. But anyway, so that's why, for instance, one of where there is a lot of volume right now after 35% decline is behind long-term treasuries. It's huge volume after 30% decline. So the market maybe is trying to tell you that investors are finding value in that sector. And there was a lot of volume, by the way, when the bond market peaked in 2021, 22.
We're running out of time. Is there anything more you'd like to add about going forward and looking forward into the future?
Well, I think, this discussion, I love this discussion. This is the first time we talk, and I love it. But again, what I would like, what the subscribers are going to appreciate is the fact that I always look at the business cycle, and I let the business cycle tell me how to invest my money, because that's the way the money is going anyway. So understanding, and of course, there are many indicators to support. For instance, here, is this a new business cycle going, or otherwise not? Because if it is not, there is a totally different investment strategy. So this is the theme, I think, of this series.
Well, I can see that.
Now, one of the things I'd like to add, that I published the Peter Dack portfolio. I'm the publisher of the Peter Dack Portfolio Strategy and Management, and people can get a free subscription on www.peterdack.com.
One more thing I'd like to add is where your cursor is right now. So it hit a peak there at about 3.5, and then it started to drop, and it looks like it rose up almost to 3.5 again as your last data point. All right.
Yeah, this takes a whole another session to talk about it. I cannot answer in just 1 minute. I got to put it in a context. If you don't put it in a context, it's the whole period here is very, very volatile, and this could be the beginning of a new cycle, but this could be also the end of the next cycle that started here. The issue is that from here to here is usually 4 years, these two trends. So if this is the beginning of a new cycle that started here, we might have 3 more years to go down the economic slowdown. What dictates that? Well, that's, again, in the next session, I'll be delighted to talk about it.
All right, let's call it quits for today and come back next week, same time, same place. Giorgio and Michael.